Well, the economy's in really good shape. I mean, there's no doubt about it. I don't know if they're the absolute best numbers ever, but they're better than we would have expected going into this year. We had a fairly upbeat economic forecast. The second quarter was very strong, but really from a consumer perspective, one of the big surprises were those huge upward revisions to income, which were in the trillions of dollars over the last couple of years, and the saving rate was twice as high as had been reported. So really, there was all this talk of how the second quarter was a sugar high. It seems to be a lot more sustainable than I think a lot of folks had thought previously.
Paul, you think that's what's happening with the market right now, that it's kind of seeing some of those things, and despite any headline risk, it's going to focus on the fundamentals?
I think it could be a couple things. I mean, listen, as you said, what the president tweeted, he's certainly prone to a little bit of exaggeration here and there, and the economy is good and has accelerated since the election. Here's what I'll offer. You know, home sales and the housing market's really under a lot of pressure in the last 6 months. That's a problem. And I'll speculate that perhaps the consumer now, because of the higher interest rates, the consumer's not buying the house anymore, not buying the big ticket items, but perhaps really juicing, as the Target CEO said the other day, regular consumer goods. If the Target CEO really believes this is as good as it gets, I just wonder how much better could it get. I can see us, printing a 3 handle again on GDP. I can see things being okay. I can't see the economy accelerating from here. There are too many headwinds, I think, coming down the pike after some of this, the sugar high from the tax cuts begin to wear off, maybe in mid-19. But certainly, the economy is not close to recessing right now. I think that comes maybe 12 to 24 months from now.
Okay, what we're talking about, the two views you two just expressed is probably what's playing out in the market right now. Mark talking about how he doesn't think it's a sugar high. Paul saying he thinks it might be. Peter, how do you weigh in on this?
The economy is good. The third quarter will slow relative to the second quarter. I mean, as the guest said, housing is moderating. Auto sales are slowing. The labor market's great. Overseas economies are slowing. Exports will probably slow as well. So there's definitely some puts and takes. I think the $64,000 question is, can the Fed engineer a soft landing or not?
Right.
Historically, they don't have a good track record. And we get deeper into the tightening in the fourth quarter and certainly next year.
So if there's something that kills this, you think it's
the Fed
over-tightening.
Always,
and that's what
always the
happens.
case. And then you're going to have the ECB that is ending QE at the end of the year. And how do markets respond to that?
Mark, how do you kind of work that into what your expectations for the economy? Because obviously the Fed is the wild card. We're going to be hearing more from Jay Powell today, and the markets are really keyed on that. What are you listening for, and what do you think the possible scenarios are?
Well, we have had some blowback from some of the Federal Reserve Bank presidents. Bostic was very clear, saying we're not going to go out of our way to invert the yield curve. And Kaplan and Kashkari, we've had a number of folks saying, hey, listen, we're not going to go too fast. So I'm looking for anything that says that December is not a sure thing, because right now we're counting on a rate hike in September and December, and we have 2 more rate hikes next year. And in our forecast, we actually have stronger GDP growth in 2019 than we do in 2018. So that would say there's a little bit more of risk that the Fed may have to do a little bit more. So I'm really looking to see if there's any change in their rhetoric, saying, maybe we need a little bit be a little more careful about intentionally inverting the yield curve.
So, Paul, you're talking about, even though we're not calling it a sugar high, you called it a sugar high. It said it's going to wear off next year, mid-19, and then it's going to run into some headwinds. Which headwinds?
Joe, I think.
Well, the housing
I don't think necessarily.
Okay, but what are the headwinds?
I don't think it necessarily definitely were. I think you have a window of mid-19 to mid-20, certainly before the next presidential election. I think that the headwind of the tax cuts and deregulation, the tailwinds of the tax cuts and deregulation. But the big key is that Mark just mentioned, and Peter mentioned, the Fed has an abysmal track record at the end of economic expansions. They're behind 90% of the recessions. What happens is they spew gasoline all over the place, and some external spark ends up happening. You look at 9/11, look when Iraq invaded Kuwait, the S&L crisis. The Fed never stops. They always go a few rate hikes too far, and I argue they'll do the exact same thing now sometime in 19 or 20.
So
that's my concern. Things are fine right now.
I thought you were predicting some other headwinds, and I wasn't sure which ones, because no one can see the future, obviously. if you're going to talk about trade, I was thinking, well, there could be tailwinds from trade if things work out. So I don't know if you can just assume that ends badly necessarily. And then the housing.
I actually think the tariffs will end fine.
God almighty. The housing problem that you talked about, I mean, that's more of a supply problem. That doesn't necessarily indicate weakness in the economy, does it?
Joe, I think you're right on that.
I'm not sure it's a supply problem, Joe. You know, mortgage rates are up dramatically, and they've moderated lately, and I think they actually come down a little bit in the short term. But I think over the next 24 months, mortgage rates will continue to go up, and that's certainly a headwind. I don't think it's a huge one. I actually think the tariff problem resolves itself favorably after we get through the midterm election. So I don't consider that a headwind at all. I think the Fed, I mean, in the history of the world, the Fed is no Fed or other central bank has raised rates and sold assets at the same time. It's never happened. So why does this Fed think they can do it successfully when they couldn't even engineer a soft landing the last time they raised rates in the 06 cycle?